Now, as aforementioned, I see the Fed raising rates in every meetings beginning in June. It's like with the taper, they had a very, very long time to prepare markets for this move, and when it begins, I believe they'll do it one meeting at a time, each time 0.25%, and they'll reconsider sometime this time next year, late 2015, beginning of 2016. Of course, bond markets are not reflecting the high rates right now. There's still a lot of stimulus in the US economy. The balance sheet remains elevated. So the Federal Reserve stopped its QE. That means it stopped enlarging its balance sheet, started buying new bonds. But for every bond that matures, it buys new ones. So it's maintaining its balance sheet. It's not really tightening. Anyway, as the Fed made it clear to us so many times, everything is data dependent. But if things continue as they are, I see a rate hike coming in June. It's hard to see it coming earlier, and some say it'll come a bit later, but I think June is the best time, the middle of the year, as they talked about. Press conference and enough data for 2015 to make a move. Okay, now let's move to oil, which has had an impact on all currencies. It remains depressed early in the year. Also, today it continued its falls. It began falling in the middle of 2014, then accelerated with the OPEC decision in late November on Thanksgiving Day in the United States. It's now WTI at around $52 or 51 last time I took a look. And I think that 40 is sort of the line in the sand. But eventually, oil can self-correct. I see less production because of lower prices and more demand because oil is cheap, gasoline is cheap. Eventually, it'll push prices back up. I believe that the sweet spot for the United States is around $65, $70 per barrel because it's important to remember that while lower oil prices leave more money in the pockets of consumers, some people are going to lose their jobs in the shale and fracking oil industries in the middle of the United States. So it's not all good for the United States. So this could, anyway, I believe we'll see volatility continuing. Also in oil prices, it's important to note the impact that it has on the US economy and of course the countries producing oil. Specifically Russia, energy, including oil and gas, is 63% of Russia's exports. The long term, if Russia suffers long term a low price of oil, it causes problems for Russia. And problems from Russia is problems for the rest of the world. So Russia could cut oil and gas exports, lift prices, and pressure the world. I think Russia seems now down, but I think it'll play a big role. It's going to continue being an important theme for the US dollar, for Europe, for many other currencies throughout 2015. So took oil as the second thing, even though I focus on currencies, because I think it's going to play a major role in the year. Okay, now let's move on to the euro and the ECB. Unfortunately for me, we have only 8 meetings this year, once every 6 weeks. But I think we're still going to see lots and lots of action from euro dollar for the common currency in general. Situation isn't good. European economy is still stuck in stagnation. It's due to lack of reforms, the tensions with Russia, which have an impact on Germany, and the strong euro, which makes European exports, too expensive, not attractive enough. Now things have changed, as we all know. Euro dollar was at 140 just at the beginning of May, and it fell since then. It's now below 120 with the avalanche of the recent days. There are good reasons. There's danger of deflation. The ECB tried doing a lot. Negative deposit rates, buying asset-backed securities, ABS, lending money to banks with the targeted loans, the TLTRO, which are loans. They're not direct QE. And I think Draghi and his colleagues made it clear that QE is coming. What is QE? Quantitative easing. It's what they did in the United States and in the UK and in Japan. It's basically the central bank printing money to buy bonds. In Europe, of course, it's complicated because there are 18 different countries, and you have to find the right political balance. The Germans are against it. We talked about it in the past, and we're gonna, of course, dive into it in the future. But in any case, it means devaluing. The impact is devaluing the euro, and I think they'll move with it on January 22nd. That's just 2.5 weeks from now. Also, another factor weighing on the euro is Greece. That's in the shorter term. In January, we have elections on January 25th, just 3 days after the ECB decision. So we're going to have a lot of action at the end of this month. The anti-bailout, anti-austerity, radical left party Syriza is set to win, but polls are very close. I don't know if you've heard the recent news, but Germany is talking about an exit of Greece from the Eurozone as manageable. I think it's part of the pressure they're trying to put on Greeks to vote for the mainstream parties. Here we have in this picture on the, actually on the right, we have Tsipras, the leader of Syriza, the radical left, and the other guy with the glasses on the left is Samaras, the center-right prime minister. Anyway, fears are mounting, even though Greece is a small country, but we might have a stuck, hung parliament, another round of elections later on in March, perhaps, and it's going to stay in the news, I think, throughout at least the first quarter. I believe eventually we'll have some kind of compromise between everybody, and Greece will stay in the Eurozone, but anything is possible. Things can get out of control always, so it's a factor weighing on the euro, at least at the beginning of the year. Another thing we have to look towards the end of the year is Spain. There's a new political party called the Podemos, which means we can. It's challenging the mainstream parties. They had big gains in local elections, in European Parliament elections, and it already resulted in a better confrontation of corruption from the mainstream center-right PP party. I think towards the elections we'll have more uncertainty, but eventually if this party, Podemos, gains a lot of seats, we'll have the center-right and center-left parties perhaps do a grand coalition. Perhaps not. It will not be the only country where this happens. So that's sort of political risk to look into throughout the year. But what are we going to see for euro dollar? I think it has more room to fall. I don't see it reaching parity, but now we're at 119. I think it could reach 110, 115. But then everything that's working now against the euro could turn to the other direction. It means lower oil prices still help the consumer, even though they push prices generally lower. A weaker euro that is a result of all the stimulus from the central bank, and perhaps the disappearance of Greek problems, everything I think will eventually lift the euro. And together with what I said beforehand about the dollar, that at some point we're going to see after the rate hike some kind of slowing down in the rises of the dollar, or perhaps a big correction. I think all in all, in the second half of the year, maybe euro dollar will make a big comeback. So I think there's still more room to the downside during the first half, and then a big comeback in the second half. So I don't think it's a one-way street for euro dollar. United Kingdom, it suffers from the weakness in the Eurozone. Recently we had a downgrade of GDP in the UK to just under 3%. We have elections in May. Here are 4 political leaders. Polls are so mixed, we could have a hung parliament that also could result here in a grand coalition between current Prime Minister David Cameron and leader of Labour Ed Miliband. But we have also the UKIP anti-EU party and also the Liberal Democrats competing for seats. So I think it could be quite messy. Now, the Bank of England, Mark Carney, will probably not want to raise the rates before the elections. First of all, because there's an economic slowdown. And he would not like to be seen as political, as, for instance, harming the current government, for example.